What's up everybody? Gen X Dividend Investor here. In this exciting video I share why Warren Buffett's Berkshire Hathaway will eventually pay dividends, something that I think will surprise a lot of people. I'll also tell you about the time that Berkshire paid a dividend, which should blow your mind. So if that sounds interesting to you, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. But first I'd like to suggest that you follow me on Twitter at Gen X Dividend Investor. Actually, Elon just rebranded Twitter to be called X, so follow me on X. I guess that means instead of tweeting someone, you're Xing them? I'll still go with tweet for now. Regardless, I try to post valuable information on each of my social media platforms to make them compelling to follow. Like a few days ago I tweeted about JNJ, and you'll understand in a moment how that ties into this video. What I wrote was, Johnson & Johnson beats on non-GAAP EPS of $2.80 versus $2.62, and beats on revenue of $25.5 billion versus $24.6 billion, and guidance increased. Then I added the following blurb. It sounds like J&J intends to split off Kenvue through an exchange offer, subject to market conditions. So I believe we only get Kenvue shares if we exchange some of our J&J shares for it. I.e., we'll get to choose how many of our J&J shares are exchanged and converted into Kenvue. Then I added, makes sense, but it wasn't what I was hoping would happen. Later I added another tweet after that one, where I wrote, it looks like J&J shareholders can exchange some, all, or none of their shares for a 7% discount on Kenvue shares. Thus, you could receive about $107 of Kenvue stock for every $100 of J&J stock you exchange, subject to some limitations. And it looks like this will go down in mid-August. Then I added that everyone should read J&J's site, along with a new site called jnjseparation.com for more info. Anyways, follow at Gen X Dividend Investor on Twitter if you want more real-time access to my perspective on important dividend-related information. If you've never been on Twitter before, then I recommend you join, as Elon seems to have huge aspirations for Twitter's future, doing things like money transfers and purchasing and God knows what else. If it's Elon, it'll change the world, so jump on now before it all happens. I really enjoy engaging with most folks on Twitter, but sometimes I'll get some negative Nellies. Like this one hater was laughing at how dividends wouldn't save investors in a nasty market, and that dividend investors must be new to the game, or they'd know about all that. He also went after a Buffett quote I made, saying something about dividends and Berkshire, and the essence was that they'd never pay dividends and blah blah blah. So I find it fascinating when people say dividends suck, as they are literally one of the two ways that companies directly return capital to shareholders, with the other being buybacks. And dividends put cash in your pocket, whereas buybacks act as a longer-term way to potentially increase stock prices. And while I personally am actually a fan of buybacks as well, that doesn't mean they always make sense to do. Like before Bed Bath & Beyond went bankrupt, they spent almost $12 billion on buybacks. I wish they had just given that to their shareholders instead. Their buybacks were over twice the $5 billion debt they had on their books, an amount that proved too much for the company. Or I read a blurb that said the US airline industry collectively spent 96% of its free cash flow on buybacks over the last decade, leaving virtually no cash cushions to prepare for down cycles. Lots of companies spent billions on buybacks, which instead could have gone in the pockets of shareholders. Bottom line, hating dividends is silly, and this data helps explain that, as it shows dividends' contribution to the S&P 500's total return by decade. It says that about one-third of the S&P 500's total return has come from dividends from 1926 until 2021 when they did the study, and over 50% of return has come in decades where we had rising interest rates, slowing growth, and geopolitical uncertainty. The reality is that many investors prefer passive current cash flows from dividends versus potential future cash flows coming from stock appreciation. Because remember, the classic reason why you invest, i.e. you put some of your money out for an asset, is because you hope to get more money from it in the future. Anyways, one of the best times to do stock buybacks is when a company can buy its stock well below its business value, i.e. when it's selling for less than it's worth, and when the management feels that they think that their shareholders can use the cash better than them in the form of buybacks. Now, some people inaccurately think that it's always better to reinvest cash into the business, but my guess is that those people haven't been around enough businesses to understand why that isn't always the case. Like, what about Berkshire? Has Berkshire only ever done stock buybacks? Was the hater correct in implying that Buffett doesn't believe in dividends? Well, let's listen to what Warren actually has said on the subject.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain. And there are many businesses. Take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms.
What we learned from the clip was that Warren does believe in dividends in many situations, including in the companies he owns that pay them. We also learned that Buffett feels that if a company can't continue to create more than $1 of value for each dollar it invests in itself, then they should pay out dividends. He highlighted See's Candy as a company that should pay out dividends if they weren't part of Berkshire, because they generate more cash than they could use to effectively grow the business. Thus, See's doesn't have the need or ability to use all the large sums of money they earn to grow their business intelligently, which is why it would be an enormous mistake for them to retain and invest their surplus cash. Instead, See's distributes all that excess cash to Berkshire, who then hopes to be able to invest that money, doing things like buying companies and such, with a belief that a dollar they get from See's they can turn into more than $1 of value for their shareholders, more so even than their shareholders getting $1 from a dividend. Now listen to this other section.
But if the time comes, and it will come someday, if the time comes when we don't think we can use the money effectively to create more than $1 of market value per dollar retained, then it should be paid out. And like I say, we do that individually within Berkshire, but because we have this ability to redistribute money in a tax efficient way within the company, we probably had more reason to retain all of our earnings. If See's Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire.
So he says if the time comes, and it will come someday, that their management team doesn't think they can use the money to create more than $1 of market value for $1 that is retained, then they will pay out a dividend. And he elaborates on the See's example by saying that if See's Candy was a standalone company, they would pay out practically all of their earnings as dividends to shareholders instead of Berkshire. I also found a Forbes article that came to a similar conclusion. They said that Buffett suggested that in 10 or 20 years, presumably after he's passed from the scene, the company may decide to institute a dividend. And then I found something that was news to me, which was that Berkshire Hathaway actually once paid a dividend in 1967. That was surprising because almost everything you read says that Berkshire has never paid a dividend, which is not true. That being said, Buffett jokes that he must have been in the bathroom when the decision was made to pay a dividend. So Buffett currently feels it makes sense to focus capital on buying back shares when they're cheap, as well as saving up capital for potential acquisitions. Now listen to this other blurb about See's to get more perspective on Buffett's take on dividends and how businesses should use capital, which I found on a YouTube channel called The Financial Review, which I'll include a link to in the description below.
A company that expects to regularly earn more than it can profitably employ in its business should be paying out dividends. Take a subsidiary of ours like See's Candy. We would love to expand See's Candy to double or triple its present size, but it doesn't work. We've tried it a lot of different ways. So it should be paying out its earnings. If it was a public company, and it was at one time, you could argue that something approaching a 100% payout would make sense there. But most management's worrying about earnings falling off at some time in the future would rather establish a lower level and therefore ensure regularity of dividends by going with a conservative level. It's obviously something we think about at Berkshire when we have $30-odd billion around. If we can't figure out a way to employ that over time, it's a mistake to keep it in corporate form.
So he says a company that regularly expects to earn more than it can profitably employ should pay out dividends. He also said they tried to grow See's Candy a bunch of different ways, but it didn't work, so paying out almost 100% of earnings as dividends would make sense. And he goes on to say that most management teams don't pay out 100% because people expect a regular dividend, so they pay out a more conservative amount of their dividend. He also said that something they think about at Berkshire when they have excess cash is that if they can't think of a way to intelligently deploy the cash, then it's a mistake to keep it within. Now listen to this next part of that clip.
If our stock was not underpriced and we fell, we would probably do something by a dividend. It's not going to happen soon, however.
So there he says if Berkshire wasn't underpriced and if they didn't have a better use for their cash somewhere in the company, then they would pay out a dividend, though he doesn't see that happening for some time. It's pretty clear to me with all that someday Berkshire will pay dividends, but that probably won't come when you have world-class investors like Buffett and Munger leading the ship. Does that mean it will happen once they move on and new leadership takes the reins? I'd guess probably not at first, but someday it will, and I can't wait for that day because I love my dividends, and I love being retired due to my dividends. But what about Buffett? Does he really believe that retiring on dividends is a viable strategy? Well, listen to this short clip I found.
If I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children had grown, the house was paid off and everything. I wouldn't worry too much about having a lot of cash around.
So I think you can glean multiple things from that clip. Like Buffett talks about the viability of being retired with a $1 million portfolio that generates $30K of dividends per year, i.e. he's talking about a 3% average weighted yield, which means a blue chip portfolio with a bit more yield than normal, and that if his expenses were low, i.e. his house was paid off and any kids were adults, then he wouldn't be too concerned about having a bunch of spare cash sitting around. So I think that points out that he clearly sees dividends as a viable retirement strategy. Oh, and that short video was on a channel called InvestTrip, and I'll include a link in the description below for you to follow them. I love promoting smaller channels like that because I know how tough it can be to grow on YouTube. Anyways, what sort of businesses do Buffett and Munger like to own in Berkshire Hathaway? Do they have to pay dividends? No, but they clearly love cash cows, i.e. ones that just spew forth cash. Let's take a look at the top 10 positions in Berkshire, i.e. ones that make up 86% of it. The number 1 position is Apple at a whopping 47% of Berkshire, and it pays out dividends. Then we have Bank of America, which pays a dividend, then American Express, also a dividend payer, then Coca-Cola, a dividend payer, then Chevron, a dividend payer, then Occidental, a dividend payer, Kraft Heinz, a dividend payer, Moody's, a dividend payer, Mitsubishi, which doesn't pay a dividend, followed by Mitsui, which has a dividend. So 9 of the 10 companies in his top 10 pay dividends. That being said, I wouldn't leap to the conclusion that he prefers investing in companies that pay dividends, but instead I'd say that he invests in companies that he feels have sustainable growth potential in the future, and ones that probably have a good track record, and often companies with good track records tend to pay dividends. My general advice to most folks is to simply invest in great companies, regardless if they have a dividend or not. And then if you want or need truly passive income, and can't or don't want to deal with selling shares, then great companies that pay dividends will probably make more sense to you than great companies that don't pay dividends. Oh, and of those Buffett stocks I just mentioned, I'm long Apple, which is coincidentally also my largest position, and I'm also long Coke and Chevron from its top positions, and Berkshire also has positions in other stocks I own, including JNJ and Procter & Gamble. Now, if you didn't have patience to wait for Berkshire to pay a dividend, then Buffett would tell you to merely manufacture your own. He said that if you want income from Berkshire, then just sell 3% of your shares each year, so kind of like the 4% rule but with 3%. The theory is that as long as the stock trends up more than that, then you could theoretically keep doing it until you croak. And Berkshire has had an awesome track record, though that doesn't mean it'll keep doing well in the future. Let's look at an example of what he means. Let's say you had 10 shares of Berkshire A stock in the year 2000. If we look at Seeking Alpha, we see that BRKA was trading for about $50,000 a share back then, thus 10 shares would be about a $500,000 portfolio. Note, as I was looking at Berkshire's stock price, I got a breaking news alert on Seeking Alpha that the Fed just hiked rates by 25 basis points. Leave me a comment telling me what you would do if you were Jerome Powell. Would you basically do the same thing he's been doing, or would you be more aggressive with hikes, or less aggressive? Anyway, if you sold 3% of that Berkshire portfolio, that would generate $15,000 of cash, and it would take you down to 9.7 shares. Then in 2001, Berkshire was trading for about $67,000 a share, so your portfolio would be worth about $650,000. If you again sold 3% of your shares, you would get $19,500 in cash from it, and you'd go down to 9.4 shares. In 2002, it was trading for about $74,000 a share, so your portfolio would be worth $695,000. If you sold 3% of it for almost $21,000, it would take you down to 9.1 shares, etc. And as long as Berkshire keeps trending up faster than you spend, then you could keep going along your merry way, selling 3% of your remaining shares. So again, invest in solid companies, and the rest will probably work itself out. And speaking of things working out, my dividend hater on Twitter reached out to me a while after that original discussion, and it turns out he now invests in some dividend stocks. Maybe he changed his tune once he saw how quality dividend stocks did well in the bear market of 2020. Or maybe he actually learned about how dividend kings have increased their dividend for 50 or more consecutive years, thus there were indeed some dividend stocks which protected their investors through multiple bear markets. Whatever it is, I hold no animosity towards him, or towards anyone for whatever they want to invest in. Now, there's nothing wrong with evolving your investing strategies over the years, but it is strange to me when people use words like hate or whatever when they're talking about dividends. But who knows, maybe they invested in some stock for its dividends, but ended up losing big, making them feel like a failure. Just remember that failing is not falling down, it's staying down. Losses suck, but if you learn from them and you keep moving forward, then you're already winning again, so don't fret about a loss. I mean, it's not over until the fat lady sings, right? No, of course not. Was it over when the Germans bombed Pearl Harbor? No, and it's not over now. Wait a sec, I forgot where I was going with this. Oh yeah, don't be a hater. Regardless of what you think about dividends, what do you think Buffett thinks about today's market in late July 2023? Well, this graph of the Buffett Indicator tells us that he probably thinks it's significantly overvalued. The Buffett Indicator is the ratio of total market cap of equities to GDP. He once said that this metric is one of the best measures of the stock market, and many believe it can be predictive of how stocks will move in the future. Historically, the Buffett Indicator trends around the 100% mark. If it's less than 77%, it means the market is very undervalued. In the middle at 99 to 121% means the market is fairly valued. And at the top end over 143% means the market is significantly overvalued. Right now it's at around 155%, putting us significantly overvalued. And for reference, the Buffett Indicator was at its highest in 1929 before the Great Depression crash, and again peaked before the dot-com crash in 2000. Unfortunately, we've been around those same high levels lately. Now, no metric is ever totally infallible, but this one probably gives us insights into why Buffett would say that things are overpriced right now, which also explains why Berkshire's cash on hand has trended so high. They're holding a lot of treasuries right now. It'll be fun to see what Warren and Charlie end up doing with their pile of cash. Probably sit tight and wait for extreme opportunities. Regardless, I'll keep owning my solid companies, not worrying about market crashes or corrections or whatever. I sleep well at night knowing that I own a fairly conservative portfolio, and I'm confident enough in my dividend stocks and cash flow that I don't feel the need to keep a huge stockpile of cash to pay my mortgage or my family's medical insurance or whatever. Anyway, hopefully now you have a better understanding of why Berkshire will eventually pay dividends, and that they actually did pay a dividend once. And now I'd normally do a shout out to my newest Patreon, Aristocrats and Kings, but I'm still all sold out. So instead I'll recognize my all-star Patreons, i.e. those supporters that have been signed up for my Patreon for over a year and continue to stay on board. Also, I'd like to recommend that everyone out there consider using my Seeking Alpha affiliate link, which usually gives you some extra perks when you use it and sign up to their service. Whatever you do, please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. And I highly recommend that you join my free Dividend Discord chat server, which has over 10,000 dividend investors on it from 76 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.